Welcome back to the show, everyone. It has been a wild start to the day. Not exactly what I thought was going to be the start to a Friday light show. We weren't expecting big things, but the Supreme Court did, in fact, come down, as you see in the chyron below, and render a Supreme Court decision which effectively attempted to shut down tariffs. Now, will it actually do that? We will get into the nitty-gritty here. The long story short of it is I think there is a strategic workaround from a legal perspective. And what would I know? I'm just a licensed attorney. And, well, we've covered this before on previous shows. There's lots of different ways to get into it. And no, Sean, I do not have a can pop today. I already got juiced up. Shout out to Andy Frizella over at First Form Energy for sponsoring the show and providing us some free product. We love and appreciate you. And if you are interested in supporting the show the same way, go to joinfridays.com, enter code HIGHER. You can get some GLP-1s, you can get some NAD if you're focused on longevity or just overall health. It is a great place to go to get that process started. Let me tell you, it is as seamless as it can be. Go to joinfridays.com, enter code HIGHER to do so. So, I'm not going to spend a lot of time doing the markets today to start the show. I'm going to spend a little bit more time with the obvious red herring, the red flag that's out there. And it's going to be what, is the news of the day. And that is, according to the Wall Street Journal, Supreme Court strikes down Trump's global tariffs. Washington, President Trump's global tariffs are illegal. The Supreme Court ruled Friday in a stinging repudiation of a signature White House initiative. The 6-3 decision written by Chief Justice John Roberts removes a diplomatic tool that Trump had aggressively wielded to remake U.S. trade deals and collect tens of billions of dollars from companies importing foreign goods. The ruling didn't address whether the government will have to pay back any of the tariff revenue, approximately $200 million. I think somebody said about $175 million. I'm not entirely sure on what those numbers actually are. They're somewhere in that range specifically. But more importantly, I think that the take-home point here is that this was something that we predicted on the show to be a likely scenario that we thought was going to ultimately impact the markets. And I think that the White House knew this was a gamble, right? They knew that they were using a narrow piece of legislature historically or law to implement this. And this is not new to this particular campaign to do that. And they knew they were going to wind up in the Supreme Court debating this if somebody brought a challenge. And in fact, that's exactly what happened here. but that they could use this subsequently as a way to point back at, hey, we tried to do what we could for the economy, and this was not allowed to happen. Here's what happened in Supreme Court. So I think this was always kind of an anticipated path for them. But that being said, that there was a White House press conference that just happened about, I don't know, 30 minutes ago. And in that conference, it was made pretty clear that he's not going to go to the Congress to get approval to do these things, and that he's going to use, he and the rest of his team are going to use other means with which they can leverage tariffs to accomplish the same goal. And frankly, he can. And that's also an interesting kind of thing to unpack. We'll get into a little bit of that in the show here. But if you thought that the president didn't have the diplomatic power to do this internationally, I would say that you're very confused as to how much authority the president does have. Now, he has to do it under the auspices of national security, but it can be done, and he will probably sidestep the Congress in doing so. And I think it was Justice Kavanaugh, if I'm not mistaken, who actually gave him a bit of a suggestion in the dissenting opinions of this article. So certainly an interesting take on how things have played out so far, not what I think anybody expected. And this sets the stage fundamentally in the country for a couple different things that need to happen. Number one, now you've got the first real loss by the White House in the Supreme Court. He was somewhat measured in his criticism of the Supreme Court and justices there in response to this loss. But there's also the outlying Lisa Cook scenario, which could reshape how we currently see the Fed voting in the future. As of right now, it still remains an undecided case, and they're going to have to rule on that. But let's check the markets real quick as we get into this. And if you're new to the show, welcome to the show. We like to use data, not opinions or politics here, to come to conclusions. If you have political conclusions or underlying theories, we're all good to hear them, but you will not hear that sentiment from me. I try to stay as neutral as possible at all times, because this is not a political problem. This is a country's problem, and it's financial, and that's what we talk about on this particular show. We do have components of AI in the show. We do have components of algorithms that are similar to what some hedge funds use, that we try to use to give you the insight into understanding what can and likely will happen in a scenario of events in the economy at any given time. That being said, there is also a real-time stream from every platform you're watching, whether that's LinkedIn, X, YouTube, and Instagram. We can bring your comments in, and we often do that in the show. Hello, how you doing out there, Meredith? How you doing, brother? Fancy Faces watching you from a line in Disneyland. Yo, my son wanted to go today. When I spent some time with him this morning before I came in, and he wanted to go to Disneyland so we can catch Pokemon. So shout out to you, Fancy Faces. I appreciate you constantly being here. And you don't have to watch us at Disneyland. You should be enjoying your family. But the fact that you are means a whole hell of a lot to me, and certainly Saeed, who, whether you believe it or not, is always lurking. He's a lurker. There he is in the chat right there. So what up, Saeed? How you doing, my boy? So let's get into the market status of the day. This is always the first place we like to start to see what's going on in the markets before we have a broader conversation about the sectors in response to things that are headline news, like this Supreme Court decision. Right now, we have no clear trend in the markets, and this is because we are in a bit of a mixed day. There is not a tech-led rally. There's not a defensive position. This is about as neutral as you're going to get with our algorithms. And for your new people who are new to this, we use the indices via a proxy of the ETFs. And the reason why is we feel the ETFs are a more true indicator, and this is debatable, I understand, because they include real cash flows, i.e. derivatives, and other types of trading that the indices will typically exclude. The percentages, however, are the same, so this gives us the same concept. This bar down below will tell us, as we go through the sectors, what the current status of events are, and that's why we start here. So let's go in a little bit to the sectors today to see how people are responding to this. I think it's important to do so. Jumping straight into the housing and home builders segment and sentiment here, we have the market is open, and DR Horton, Lennar, Pulte, Toll Brothers, and NVR are at a bit of what I call a mixed neutral day. Again, this is the same position down here that we talked about from the market status. So nothing meaningful here. Even though you've seen mortgage rates drop down, this rate-sensitive demand has not seemingly crept up, which is part of the reason that our home affordability indices seems to suggest that supply is not the biggest limiting factor, although it is a limiting factor on affordability in this economy. And that is a very controversial take, according to people that are on Threads and some other platforms that have attacked it. I respect those opinions, but I respect them a little bit more when they've got data behind them. The banks, let's check the banks out. Credit conditions have not deteriorated. We did see some deterioration in private credit yesterday, and some of the conversations around that I think were meaningful. You're going to continue to hear concerns in the economy of people worried about private credit. Non-bank lenders lending at standards that banks likely cannot and would not lend to is going to be a thematic risk in the economy. I think you're going to see that. But if you've been watching the show, you know that we believe in the banks. We believe that net interest margin, their main profit vehicle, the difference between what they pay on deposits and what they charge on loans, is going to continue to widen in this economy, particularly as you see the treasuries rise over the term of the next couple of months and or years. And I think, look, we lived through 15 plus years of artificial interest rate deflation. I think the current rate environment will be better, even if it stays stagnant, than what we saw. So as these loans roll off their books at 3 and 4%, and you replace that with 5 and 6% or even higher interest rates, banks are going to make more money. That's why we believe in this sector a whole hell of a lot. CRE real estate is going to get a little bit smashed over time, largely because, look, you got a big chunk of loans coming due. And we'll explain what this means real quickly for the new people. Typically speaking, in commercial real estate, you're getting a 3, 5, or 7-year hybrid loan. What that means is you got a fixed period for 3, 5, or 7-year loans. And unlike consumer real estate loans, you've got a prepayment penalty, which typically locks you in to match the duration. So a 3-2-1, for example, prepayment penalty on a 3-year, or a 5-4-3-2-1 on a 5-year, and you can have variants like 5-4 or 5-3-1-1-1 or whatever it might be. But you're usually locked in for every single year, and the prepayment penalty goes down based on the duration there. So these products, which are not fixed for long duration loans, sometimes you get some 10-year product out there, sometimes some 7. That's usually in the bigger loan dollars and conduit and a little bit different. But for most people, 3, 5, and 7-year product, that all comes due. And as that comes due, it's readjusting to an interest rate environment that is almost, in some cases, 2 or 1.5 times what it went through. Now, unlike your home, where you can get a loan to value based on the value of the property, you get an appraisal, you get a loan to value, commercial real estate doesn't operate this way. What happens is your cash flow is the main driver, something known as the debt service coverage ratio, right? For every dollar in income, how much expense do you have? And that number typically needs to be somewhere between 1.15x or higher. And some banks are about 120 or 135, depending on what type of product. If it's multifamily, it's lower. If it's commercial real estate, i.e. office or retail, it's typically higher. I think 125, I think 135. Underwriting parameters vary here. But this drives how much of a loan you can get. So basically, we want to know that your property is cash flow positive by, at least in this case of example, 15 cents for every dollar in expense that you have. That being said, this will reverse engineer into a loan to value. But as cash flow drops, this leverage drops because the value of the property is worth inherently less. And this makes sense fundamentally because income producing property, investment property, is a vehicle with which you can generate revenue from. And if you're able to generate less revenue because of a higher interest rate and larger mortgage payment, that revenue decline means its inherent value is worth less. Think of it as a discounted cash flow analysis light, if you will. So you're going to continue to see that challenge in the commercial real estate sector. And I think a lot of the narrative will also be there, similar to what we're seeing in the private credit markets. Let's go into the mega caps. You know that we've felt on the show that the mega caps have been slightly aggressive and almost a bubble, if you will. I think it's undeniable there's a tech bubble. We're going to continue to see a little bit of a softening in the interest in mega caps as people say, hey, AI's been out there. Let's see you prove up. Let's see proof of concept. Let's see the efficiencies and the extra profitability built in, because they're spending billions of dollars on CapEx expenditures for AI, which we have yet to see the actual inured benefit, although we are in the world of agentic AI and we are starting to see some really cool things happen. Think OpenClaw, i.e. Moltbot, i.e. Cloudbot, start to really develop. And I think agentic AI obviously breeds the way to what I think is the next level of truly AI growth, and that's AGI. Obviously, there's some power elements there, which we're going to get into here shortly. Let's get into the consumer side. Walmart has been a conversation point as of late, getting kind of hammered a little bit in the markets. I still believe in consumer health in the sector. I know that the consumer is stressed, but these are necessity purchases. Walmart, Target, Costco, Home Depot, and Dollar General. Home Depot being the only one that'll give a bit of a caveat out here. So these are where people go to spend money. They're going to have to eat. They're going to have the bare essentials at home, and these companies sell them: clothing, food, things like this. So these are not like the high-end retailers. And I think that this is where the money will go as we start to see more aggressive challenges to consumer consumption. We already know credit card debt is at an all-time high. We know that we're at the second highest next to the great financial crisis, 12.7% default rate in the sector. And as you see this creep up, I think you're going to see stronger sector response here. But let's take a look at Walmart briefly. I think Walmart's a great example of kind of some of the things that are concerned about in the, let's see here. There we go. In the market. And I'm going to pull up the stock ticker here. For those of you who haven't seen our stock market ticker, this is what it looks like. We try to show exactly what's going on in the day. It's intraday trading. This is your session high. This is your session low. It did open up higher, and we are starting to see it trail off a little bit. We have seen some price improvement a little bit throughout the day. So let's take a look at the 5-day. This is going to be an ugly chart, just full disclosure. Let's get into that. There you go. Walmart is on a pretty steady path down. It's aggressive, and it's kind of fascinating to watch, but I think this is temporary. I think you're going to start seeing some pretty healthy returns. This is a 1-month chart. It looks a whole hell of a lot better. And for some perspective, in case you're thinking that times are bad and everybody's scary, this is Walmart's 1-year chart. So again, if you're into this for the long term, which I think you should be for a trade like this, I think you're just fine. This is a momentary blip because they were a bit passed up by Amazon as a large retailer in the world. So I don't see this as a big bump in the road. There's lots there to unpack, but I think for the most part, I think Walmart's going to be just fine. Let's get back to the sectors, shall we? Let's get into some interesting ones. The industrials, we had a good day yesterday for Deere. They had a great pickup yesterday. I think a lot of people saw that in the markets. Caterpillar, Deere, General Electric, Union Pacific, 3M. These are where the industrial real economy really sits. And I think that this is going to continue to be strong, assuming that some of the tariff stuff does bring jobs back, but I do deeply worry about the affordability of a lot of things in the economy and how this might play out in the short term. Deere yesterday had a great number beating earnings. Let's take a look at them real quick. I think it's probably worthwhile to look at that chart and what happened yesterday. Let's take a look here. I'll pull that up. Let's get into the stock chart. There you go. There's Deere and Company up 30.49%. Look at that. And that's what happens when you beat earnings, kids. Even though we're in a world where, we say it's really difficult to continue to grow like this, but that's a 1-year chart. Let's look at the 5-day chart where you're going to start to see them look a little bit less sexy, but still pretty good. There you go, up 9.9%. And this is the day they announced that earnings beat. And this is why we tell you, you really got to pay attention to earnings calls, earnings reports, because by the time it hits the street and you hear about it in the main headline news, stuff like this has already happened. And if this has already happened and you're not watching this stuff, you miss out on that upward swing. Now, again, we're not investors for the short term, so none of this really matters to us. But if that's what you happen to have as your cup of tea, then guess what? This is kind of the thing you have to watch, and you got to really get deep into the weeds and be ingratiated in it. Finishing up with the sector conversation, let's pop on over to energy, which we are big fans of on the show. The geopolitical supply risk here, however, is weighing heavily on this. Exxon, Chevron, Conoco, Schlumberger, EOG Resources. This is the energy sector, not only electrical, but obviously gas and fuel, oil prices. You're going to see some constraint and some frustrations here going through as this Iran controversy continues to spike up. There is a lot of people in and around that space right now, and there's a lot of uncertainty as to what may or may not transpire. And uncertainty, which we're going to get into here with our synthetic volatility index, is not a good thing when you're investing in the stock market. So if we worry that the Strait of Hormuz is going to get shut down, or there might be war conflicts in the region that impact this, then we have to price accordingly. And that is what the risk is really doing here. The defensive stocks, that we see that a lot of people go into this space when they're concerned about everything else. We did see a risk off position in crypto, which has not gotten materially better, by the way. And as we've seen that risk off, we expect to see more and more as we get towards what I would call further deeper cuts in and around this position here. You should see the defensive capital preservation stocks, Procter & Gamble, Coca-Cola, Johnson & Johnson, Xterra Energy, Duke Energy, continue to creep up over time because people are going to look to preserve returns. And that's where the money goes. Let's spend some time looking at the calendar. We're going to talk a little bit today about the GDP print, which did in fact come out today. All the things notated here in black are the important parts. Those go into our model for important macroeconomic factors, which could and likely will impact the economy. We do have some consumer confidence coming up next week on Tuesday. We have a durable goods order month over month on Thursday. Otherwise, most of what's going on next week will not be super sexy. I will point out one other note. Case-Shiller Home Price Index on Tuesday should be interesting. So I look to see really these on Tuesday and these on Thursday to be valuable ads for what we're talking about from a macroeconomic perspective. But certainly GDP's miss today was a big point of conversation. I don't think people saw that coming. I kind of saw it coming a little bit, and I don't think it's as negative as people make it out to be. So we did have a miss there. We're going to get into that here shortly. But the GDP miss in my mind was still not as a bad thing. You had a massive snowstorm. You had a bunch of things happening. So I don't see that as a huge hindrance. And let's not forget there was a government shutdown. So if you had a government shutdown, this massive snowstorm, So yeah, that probably took away about a percentage point. If you add that percentage point back in and you were somewhere around the 2.4% mark, then in theory, I don't think you had a miss. I think you were right on target where they thought it was going to be about 2.4, 2.5%. So I don't see that as a huge economic impact. I don't see a whole lot of scrutiny around that, and I don't understand the fanfare, but lots happen in the media that I don't necessarily understand. Jumping over to synthetic volatility index, despite all this headline risk, despite the Supreme Court and the tariffs, despite the GDP print, despite all that negativity, we are seeing a relatively calm synthetic volatility index, this being our proxy for the VIX. And what we do is look at realized volatility, intraday trading stress, gap risk, cross market, and we can come up with a synthetic volatility score that tells us the market is in a calm position, which you can see here in the heat map. This is about as calm as you get in the stock market. It's not going risk off. Nobody's unstable. Nobody's panicking. So this tells us that despite all this headline risk and the fanfare from the media, this is much ado about nothing as of right now. Sure, there could be some implications from tariffs, but if there are, until those materialize, you're not going to see any risk off further from at least the people that are investing on a daily basis, because they're not necessarily worried about that. But what they are looking at is something that we've talked about routinely in the show. They are looking at something like the market in crypto. Right now, crypto is not the sexiest it's been. I'll be candid with you there. Let's go over to Bitcoin. We've seen Bitcoin now drop from 126,000 at its peak not too long ago. About 50% of its value now, if not a little bit more, is down. This is a 1-year chart, $67,718. And as a reminder, it's somewhere between 84 and 85K per Bitcoin to mine with a value of $67,000. So as I have pointed out before, this is not an economically viable trade until this goes about $20,000 a coin higher. And even then, you've got rising electrical costs due to AI, data centers, and all the things that are happening. So the future, in my mind, of Bitcoin remains to be unclear. And investors don't like unclear certainty, unless you're Michael Saylor, in which case you love the idea that you can go down to $8,000 a share, a coin, and possibly make some money there. So good for him that he's that confident. I do not have that level of confidence. Let's look at Fed liquidity. The Fed has still been a little more restrictive. We're seeing what we expected here happen. The Treasury account is continuing to bump up, and we are going to see some reverse repo borrowing. This, as a reminder, takes the Fed's current balance sheet, which appears to show heavy liquidity in that they're flooding liquidity here, and nets out the things that we knew the Fed was going to do. They said that in the FOMC meeting. They were going to brace for tax season, if you will, and give more and more bank access to the Fed repo line. So that shows us that we're in a bit of a tense, restrictive position still, as liquidity is still a net drain in the system, not a net add. When that flips, you're going to see yourself in a situation where this chart becomes a little bit more sexy, if you will. It'll move this Chiron and Chevron all the way over there to the right to the more supportive flood range, and that gives more liquidity in the system, and hopefully that'll start easing things up. But I don't expect to see that. And as a matter of fact, the Chicago Mercantile Exchange Fed now shows that we're not seeing a Fed watch tool, I should say, is not showing a whole high probability of Fed rate cuts. Matter of fact, none of this has materially moved the needle. I think the Lisa Cook decision will likely move the needle as far as probabilities go. But just to give you guys a look, Saeed and I looked at this last night. It was a little bit lower. It's actually a little bit higher today, but let's share it anyway. This is your Chicago Mercantile Exchange Fed watch tool. The Fed now, you have a 96% probability of making no changes to the rates. There's a little bit more than a flat 4%, I would call it, probability of a 25% basis point rate cut. As far as I'm concerned, that does not exist. This is about as certain as you get for holding rates steady during the March 18th Fed meeting. There is not a high probability of responses there. And guess what that means, kids? That means that all of the stuff that you're seeing in the news right now is unlikely to impact anything. Probably the most controversial thing that we see here, and there has been some movement, kids. Guess what? We got Q4 2025 finally up here. And in the Q4 2025, the supply constraint actually went down. So we are seeing additional supply pressures in the last quarter. And again, this is Fed data fed directly from the St. Louis Fed into us. And as a result of that, we've seen some things happen since the last update, which was way delayed. Okay, number one, the model shows that we're still stretched here, right? We're borderline strained in the overall affordability of housing in the economy. And I'm going to try to do this clearly because there's always somebody who loses their damn mind over this, right? Okay, number one, mortgage payment burden is difficult. Now, it is getting back into a position where as rates continue to drop down a little bit lower than where they were in Q2, for example, you're starting to see mortgage payment and your mortgage pressure start to align a little bit more with income strain. So as these strains line up, now this is what I mean right here. This 60 number is what I mean when I say that supply is not the biggest constraint on affordability right now. This really pisses people off because they have this remedial supply demand economics conversation where everything else is static. There is friction in the ability to buy. Affordability is based on friction of price movement. And yes, supply long term determines that, right? Near term, however, you have credit, rate, and income friction that is driving demand in a way that is meaningful and palpable. And when I say that supply is not the biggest constraint, let me show you what I mean by that. Actually, let's do this on the bigger screen here. Look, okay. Number one, in a static environment, assuming nothing else changed, okay? And let's just get rid of this for a second. In a static environment, assuming nothing else changed, right? You've got your home values. Those could go down by approximately 30 to 35%, and homes would be more affordable, right? Or you could have your wages. Your wages could go up by approximately 52%, and these are general numbers, and homes would be more affordable again. Now, I don't think either one of these are likely to happen anytime soon. So this is why you see pundits say, okay, well, what about interest rate? If interest rate went down approximately 1%, guess what? You would be closer and more affordable than you would be today, obviously, but you would be almost in line to about a 35% drop in home, and that's how impactful mortgage rates are. Now, I say this not advocating for additional rate cuts. I don't think that's smart. We're still below the historical average of 8%, even at the low sixes, high 5% that we're at today. That's a sensational rate relative to historic numbers. I don't think anybody's advocating for that, and I don't know that the Fed funds cuts are going to prompt that, frankly, based on where the treasuries are going. So, asterisk there. But what I say when I point to things like the home affordability matrix, and I say, hey, look, home affordability is in fact strained, but supply is not the biggest factor today. I mean that, look, in order to get construction to the market in deliveries, you need to have 18 months, 12 to 18 months of construction before you get deliveries. And we're seeing some of that, but supply is coming in low. Permits are being requested at historic low numbers, and deliveries are coming in low. So that is not going to be accessible and fixed anytime soon. And bringing this in the market is a slow, prolongated effect. So yes, supply is going to drive prices down if it hits the market. But the near-term solution, unfortunately, is going to be two factors that are going to be meaningful. I don't think rates are going to drive a whole lot of this. It'll be incremental here and there. Wages have to catch up, which takes time as well. And home prices have to come down. I don't have a catalyst. I don't have a solution. I'm not an economics expert. I just look at data a lot. And I can tell you that those two things have to happen. And someone's going to say, well, Chris, how do prices go down if there's not supply? People can't afford it. They're not going to buy. Prices go down. And you need to look no further than a very, very obvious example, which we know is true. New homes, net of incentives, okay, are much cheaper than existing homes on average today. That bothers some people. I'm going to bring up some data here, and I'm going to show you this based on something that we also covered on next Tuesday's podcast live, Saeed and I, which goes over some of those numbers. So you think that I'm not crazy or as crazy as you might think that I am, where look, home builders are clearly seeing a drop off in that price. To me, that is a very meaningful moniker with new homes being slightly cheaper than existing homes. But 25% below where they were just a couple of years ago in value is a big change. So let's look at that, okay? Let's spend some time here and let's go through it. And while I'm doing that, let's jump over the comments real quick. Does anybody out there want to talk to me? Yo, Saeed, Sean, Cam, Pop, how you doing? Instagram, Putts and Golf. Oh, my wife's in the chat. What up, wife? How you doing? Jackie, Chris, how you doing? Yeah, there you go. Hey, everybody. What's up? Okay, so let's take a little bit of time and let's look at exactly what I was talking about the other day. Let's see here. I want to pull up one piece of data and read it to you. Okay, so Lennar. Lennar is, in fact, one of the largest home builders. They are on our home builder sector analysis. And here is a look at Lennar's average price per home sold and Q1 mid guidance coming straight from their financials. This is via Wolf Street and sourced from Lennar's data themselves. Q3 of 2022, this number peaked. I'm going to read to you a little bit about what that is. And here we are approximately 25% below where it peaked today. These are their new homes they're delivering to the market. Lennar, one of the largest home builders in the U.S., has been trying to maintain its sales volume by piling on incentives, cutting prices, and giving up a substantial part of its big fat pandemic era profit margins, i.e. this, right? and building at lower cost using cheaper materials, which I don't ever know is really a good thing, but that's what we're going to get. And that's just how economics work, right, kids? Capitalism. As a result, the average price of homes that it sold has plunged. And for Q1 of 2026, it guided the average price down further to a range of $365,000 to $375,000. So we're talking 365K to 375K is your average price because incentives will vary, whether it's rate buy down, appliances, things of that nature. The midpoint, 370, averaging these numbers out, gives you a whopping midpoint of 370K for the midpoint of their new home sales. Would be the lowest sales price since 2017. So if you look down here and you go across this way and you go that way, that's what they're talking about. It'd be the lowest price since then, all right? And down by 25% from its peak in Q3. When this number, just for those of you who want to know, is about 491K. 491K versus 370K, that's a big give up just to drive sales volume. So people are saying, well, sales volume is fine. Well, it's not fine, kids. It's not fine. So don't let the headlines fool you. Let the data control you. Now, again, I'm not saying we don't have a supply issue. We absolutely have a supply issue. I'm just telling you what to think about the data as you see it. And of course, the natural overlay of this chart, and I am going to put them side by side at some point in time, is worth sharing with you here. Let's get into that. This is completed new single family houses for sale comparatively over the years over that same period of time. So as you see new homes being delivered to the market, you saw back in this period of time, right, you had new single family homes delivered. Now, this right here, if we overlaid recessions on it, would be recession number one. You would also have the pandemic era recession somewhere in that range there. And then we have the current period that we're in now. Let's be candid about what this chart is really saying to you, okay? Look, this is new single family homes for sale. This is not foreclosed homes that crept up from a supply perspective during the great financial crisis. Money was cheap, credit was loose, builders got a lot of money to build a lot of homes, and the demand seemed never ending. So they built and delivered more homes than we had seen in history. And as a result of that, combined with the defaults that we saw during the great financial crisis, and that was the credit defaults we all knew were likely going to happen looking back on it in retrospect. We've all seen the movie The Big Short. Synthetic mortgage-backed securities were a problem. We don't have those credit problems today because Dodd-Frank and the ability to repay rule that came out of it ensures that lenders have much tighter credit underwriting, which is why most of the credit concerns that you see are centered in private credit markets and in the office commercial retail space. Okay, so those two markets aside, you're seeing the builders get smart. They had an aha moment in this span of time where they go, okay, wait a minute, wait, hold on. Let's figure this out from an economics perspective. Okay, simple. If we control the supply of units and we know that we make less money if there's too much supply, we will not deliver as much and we will try to control the sales price, which is why you're seeing them play hide the sausage with the incentive price that we just talked about in the previous chart. And I think that's something to understand, that builders have to be incentivized to build if they're going to make less money. If builders have to build more in order for us to get more supply and drive down home prices, how are you going to incentivize them with profits in order to do so? No one answers that question. And I'm not sure that I have a pure answer to that question. I just know that every time this supply and demand argument comes up on the social sphere, that this is the same question that I scratch my head and think to myself, okay, you're saying that supply is a bigger constraint, and look, that's fine. It's all good. Everybody's entitled to their opinions. I respect it. I like them a lot more when they have data with them, but I get it. How are you going to solve that rubric? How do you get builders to build and put more supply out so they make less money? They have to sell more volume. Well, you got to convince them that that's going to happen. And I don't know that they believe that that's going to happen. Here's the two charts side by side. Here you have completed new single-family houses for sale in the thousands, and here you have Lennar's average price per sale home. Now we've got deliveries coming to the market in more than here, and then you got values coming down this way. Of course, the natural argument could be, well, Chris, they provided all the supply, now values are going down, but that's not the data that we're seeing across the country. Now, is it? Values are going down, but not a whole lot, and certainly in some areas that's not ubiquitous, right? Real estate is hyper-localized. So the question is this causation or is this correlation? And I'll leave that because I don't want to piss anybody else off more than I already have today on the real estate side of things. But there is a compelling argument here that this is not driven by supply, that the supply is actually reacting to an all-time housing unaffordability. And I want to hear people's thoughts. If you think I'm crazy, that's cool. I get told that a lot by a lot of people who know me really well. So it must be true. All right, we're going to spend some time going into the social sphere. I am going to skip. So For those of you who may be new here, we do a whole forecast segment. We have XAI, which we use. Something that I do is I typically will pull down. Actually, I'll show you the chart right now. I haven't updated it here. This is what it looks like whenever I do update it. I'm trying not to update it today because I don't want to spend a whole lot of time going over the social rhetoric because we know what they're all talking about, right? It's right here. That's what's covering the major news headlines today. It's going to be that right there. So let's spend some time getting into what I know will likely be the more sexy topic of the day. Let's get on over to X and do the social view. I know some of you don't like this view because you can't see it very well, but we're going to be here looking at it anyway. This from the White House, effective immediately, all national security tariffs, Section 232, existing Section 301 tariffs remain in place and in full force and effect. Today, I will sign an order to impose a 10% global tariff under Section 122 over and above our normal tariffs already being charged President Donald J. Trump. And yeah, that should have been the natural and logical conclusion that was going to happen here. He doesn't want to refund or give back 200 plus or 175 to $200 million of money. Why would he want to do that? He's not properly motivated to do that, and frankly, it goes against his agenda. So you had to see that as the natural and logical conclusion here. There is a bunch of press conference data here. You know what? Let's listen to some of this. Let's see what it sounds like, shall we? And for those of you who don't want to listen to it, that's all good. It's not political. This does impact our finances, so let's get into it. Ready? Here we go.
In order to protect, and it says so, in order to protect our country, a president can actually charge more tariffs than I was charging in the past period of a year under the various tariff authorities. So we can use other of the statutes, other of the tariff authorities, which have also been confirmed and are fully allowed. Therefore, effective immediately, all national security tariffs under Section 232 and existing Section 301 tariffs, they're existing, they're there, remain in place, fully in place, and in full force and effect. Today, I will sign an order to impose a 10% global tariff under Section 122 over and above our normal tariffs already being charged. And we're also initiating several Section 301 and other investigations to protect our country from unfair trading practices of other countries and companies. Thank you for your attention to this matter, and I say quite simply, which I've said for a long time, make America great again. And interestingly, we've already made it great, so I don't have to use that, but I don't think we'll ever give up on MAGA. MAGA is always going to be with us.
All right. Well, there you go. As anticipated, the White House is doing what the White House typically does. Let's go to the comments, see what you guys all think about this, see who's out there. Hugh, look at you in the chat. I haven't seen you here before, Hugh McCain Jr. I believe you're coming from the Restream side of things, probably on LinkedIn last I checked. Homeowners insurance, maintenance, property taxes, energy, and utility costs. What components go into fully burdened home costs? What square footage price on new home is market based? Okay, a lot there to unpack. Let's see here. Homeowners insurance, maintenance, blah, 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 and utility cost components go into the full broadened home costs. We actually covered this on the show under the auspice of what is and is not shelter costs on a previous episode. I will admit that I don't have it memorized, so I'm going to pass that. I'll pass you to the episode where we covered that. I'll try to find that to you, and I'll message that to you on LinkedIn, Hugh, if you're still there. But basically, the shelter cost is a much more complex question. It's number one, it's delayed data, it's lagging indicators. Number two, it's an incomplete process where not all this is really mathematically articulated well. And then when you dive into it, you have owner's rent equivalent versus everything else. So it becomes a very difficult analysis, one that we don't like because we don't feel that it's a real natural reflection of what the consumer is paying. Similar to things if you were to look at, like on inflation, on basket of goods methodology, we feel that that methodology is inaccurate and most likely, I guess, usable adjacent, if you will, where we know that's the standard, that's what we use, but the real world implication to us just feels a lot different. So we can get into some of that on a show. We can message that offline. I don't know that breaking down the nuances of it here is the right thing to do. Let's go here. It's always market dependent, but that is my feeling. We need Southern California market. I'm assuming the supply demand argument there from you, Sean. What else we got? Also, a better question would be what fully burdened costs relative to income. Yeah, to Saeed's point here, Hugh, I think that's also a great question. Is we also do this a lot where where we talk about the cost of housing and ownership and some of these net costs, insurance, taxes, utilities, things of that nature. But relative to income is the biggest point of contention that I typically have in these dialogues, right? Is if wage inflation has not kept up, and I'm not saying that it should have, it always lags and it always takes a lot longer to catch up. If wage inflation has not kept up with these things, even an incremental inflation above wage inflation, which doesn't seem like a large number, will have a material effect on the ability to repay, not only for underwriting purposes, which is a friction point for this affordability argument, but certainly just for the overall humanity of the consumer, right? They're going to spend less money on disposable income items because they don't have it. Right now, we're seeing that go to the credit side of the world, whereas I don't think that's necessarily a healthy trend long term, and certainly the credit default rates seem to suggest that. Thanks, Saeed. Let's see what else we got here. Let's clear this quote here. I'm going to go over to Instagram real quick for those of you that are out there. We get some inflows and outflows on Instagram. Just to be candid here, the vertical stream is a little bit more delayed and lagged than the stream on X, on LinkedIn, and on YouTube, so that horizontal feed, for reasons that are unclear, just tends to be a little bit more up to date. So if I don't respond to you right away, give me like a minute or two, because it doesn't pop up here in the same cadence with which everything else comes up here. All right, so let's go back to the interwebs on the social sphere. And Hugh, thanks for asking the question, bro. Thanks for coming over. I know that a lot of people don't make that crossover, so it's kind of cool to have people join the platform. I'm going to go back to the social view. Here we have a lot of, again, all rhetoric. This is a good one. Realizing American citizens paid $175 billion in illegal tariffs and it's being refunded to companies instead of back to us. When I messaged Saeed in the morning about this, Saeed was like, well, you were right. And I'm like, well, I don't enjoy the idea that I questioned it. But one of the things that I typically do, just this is my legal background, is that I will typically look at things, and I'll use student loan here, student loan forgiveness, and I go, how are similarly situated people being treated differently, and how is this constitutional, right? And look, the president has broad powers, but we have a system of checks and balances in place, and we have these systems in place, i.e. tax power going to Congress. And one of the classic arguments I think we can look back on and say, okay, if the White House needed to spin the narrative that this was not being passed on to the consumer, and now we know why, right? So the Kiel Institute, the COB, and the National Bureau of Economic Research had come out and said that the consumer bears the overwhelming majority. As a matter of fact, I think the lowest prediction, or the lowest estimate, was 90%. But 95, 96% was a pretty common number by assumptions. And there was a number of major media outlets which covered that. Now we know, based on the decision made today by the Supreme Court, that they specifically reference Congress's ability to tax the people. Well, in effect, if the tariffs are being passed on to the consumer, and that is effectively a pass-through, that is a tax on the consumer. And from a constitutionality standpoint, that power is supposed to rest with the Congress. And that's also why you're seeing some of the sidestep here under the auspices of national security and some of the things that he mentioned here. A lot of these sections he referenced, I want to say 122, and I think it was 301, was it? Yeah, 301 tariffs. Those are, I think, national security related last I checked, or they have some type of implemental things there. And as you can see here, this is just dominating the headlines today. Although this is the part we really need to talk about. Fourth quarter GDP, 1.4% missing estimate badly. I don't know that I'd go that far, but let's look at the article here. Fourth quarter U.S. GDP up just 1.4% missing, badly missing estimates. Inflation firms at 3%. Okay, so first of all, inflation hit the target number. So let's just get that out of the way. You can see that's a secondary anecdote here. And this is what really bothers me about mainstream media, where they're using this as a headline. And I use clickbait headlines too. If you've seen me on X or Threads or whatever recently, you know that I've been using a little bit more inflammatory language to try to get some attention on the channel. We're trying to provide education. That's just how we do it. Sometimes I question about this. And your boy over here, yeah, between Steve Leisman and some of the stuff that we're seeing here from my boy Ricky, look, Rick Santelli is a good dude. I like him a lot. I got a ton of respect for him. I posted a clip of this earlier today. I'll probably play a little bit of this for you right now. He was legitimately shocked at this number. So this is also the same guy when the previous inflation print came out. He was beaming. Yeah, we beat it. Yeah. I mean, so to see him down kind of sucks. And I've got a tremendous amount of respect for Rick Santelli. So don't let this fool you here as I talk my smack on him a little bit. But let me cue this up. Let's get in big. There's gonna be some commercials playing. Don't mind this while this is going on in the background. But your boy Steve, he was down when he read this, and he was down bad. You could tell this really bothered him, and that it threw him off a great deal. And you know what? I guess they give it to these guys in real time, but that's what they did.
Welcome back to Squawk Box. Rick Santelli here live at CME HQ on this important Friday with some key breaking news. Personal income and spending for December, including some of the Fed's favorite metrics. First look at fourth quarter GDP, and the numbers should be populating. We're going into this with yields moving lower. And on the GDP side, a big disappointment. We're looking for a number around the 2.8 area, comes in at 1.4. 1.4. 1.4 would be the lowest
He's
GDP
checking it twice.
since
He's
the
like,
first quarter of 25 when it was negative, slightly negative, around 0.5%. Now, if we look at consumption, comes in as expected, 2.4.
Yeah.
But that's about a full percent less than the sequential look at the final read last quarter. 2.4 would be the lowest since also the first quarter of 25 when it was 0.6.
you get the gist. I'm not going to give the whole play to Rick Santelli. I have a tremendous amount of respect for the guy. I like him a lot. He's really good. He's animated in the right ways in the show. And frankly, his live coverage does make a relatively dull topic pretty interesting. So if the retailers pass the tariff hikes on to consumers, do we file a refund? Where do I file? Sadly, you're not going to get that refund. I apologize, brother. The refund will likely go to the companies, not to us. So it's a capitalism play. It's not a consumer play. So I guess you can make an argument that of some type of economic benefit to us in the form of tax returns. But in a lot of ways, I'm worried about that because that will function more like stimulus checks and then kind of spark the economy in a way that we know has given us artificial interest rate deflation and then artificial income benefits. So I don't know that that necessarily is a good solution to the affordability crisis, having that even play out anyway. And the tariffs, if anything, should go to the national debt, but that's a different conversation and likely not to happen. So let's take some time to look really quickly at this. U.S. growth slowed more than expected near the end of 2025. The government shutdown impacted spending and investment. While a key inflation metrics showed high prices and still a factor for the economy, according to data released Friday. Gross domestic product, and here's the headline number, and it's right there. I know you can't read it. I'll read it to you. Rose at an annualized rate of 1.4%, according to the Commerce Department, well below the Dow Jones estimate for 2.5%. Consumer spending increased at a slower pace for the period, while government spending tumbled sharply in quarter marked by the record-length shutdown. And this is the part that I want to be clear on. The department estimated that the shutdown subtracted about 1 percentage point from the growth, though it added that the exact impacts cannot be quantified, and that's fair. For the full year 2025, U.S. economy grew at 2.2% pace, down from 2.8% increase. So again, okay, look, let's be clear here. We had a wild snowstorm on the East Coast, which shut down a lot of stuff, right? This is GDP, and GDP is largely propped up by government spending as well. But you also had a government shutdown, a meaningful one. So you lost about a percentage point. Let's just add that back in. I know these are approximate numbers. 2.5%. That is not a miss, okay? So this headline didn't shake the market. That's why you didn't see the synthetic volatility index or our version of the VIX react in a bad, adverse way. I think what you got here is a market that's looking at everything going on, saying, okay, there's a lot of headlines here, there's a lot of risk, a lot of things happening in the zeitgeist, but until that time actually impacts the markets, and we're not seeing that impact the markets. We're getting a little bit more of a defensive position throughout the day. We started off over here as a mixed day. We're getting a little bit more down towards a defensive position of hiding in safety, hence the title change here. But again, the risk profile of the markets hasn't changed materially since we started this conversation at the top of the hour and to where we are today. If the sell-off begins, you'll start seeing things go into defensive, risk-off, and liquidity position. But I don't see that happening outside of a meaningful piece of information that were to occur. For example, if we were to have a strike against Iran, that could possibly trigger that. So who knows? I mean, at this point in time, it's unclear. But look, it's a Friday show. I like to do Friday light shows, a little bit more data light than we're seeing here. And I do apologize for that. But I want to spend some time with the comments. Because look, this is dominating the social sphere. We know exactly what's going on social media. Let's talk to you guys out there. How's everybody doing? Where are we at today? Let's see here. Let's go over to the chat. Saeed, you still listening, brother? You still out there? I got Sean in the chat room here. Who else I got? Let me take a look. I'm getting blind. This is the problem with putting glasses on and taking them off. When you take them off, you can't see a damn thing. I got Sean out there. I got Samson. How you guys doing? Let's see. We already covered Hugh earlier, which was a little bit surprising. I do owe you a can pop, which I do have to open up. On the Instagram side, Yoshi, it's really nice to see you here, brother. I don't get to spend enough time talking to you. And we were talking about how glorious your beard was the other day. So if you want to bring that here and grab some lunch, come on through. I think that's where we should probably end it for a Friday light show. I think there's going to be a lot more fanfare over the weekend. Don't be surprised if you see some headlines creep up and some wild things come into the ether over the course of the weekend. It would not be surprising to me at all that heading into Monday, some of the stuff is attempted to put into the rearview mirror, or at least the context is framed around it. But for right now, look, keep your head up, stay positive. The economy is always a changing landscape, and it's always going to have its difficulties. It's always going to have its political influence. And there are always going to be people who take a difference of opinion than what you may or may not feel. Sometimes it's motivated by politics. Sometimes it's motivated by just a deep personal belief. Health and fitness, personal finances, religion, politics. And, these things are really, really, really meaningful to people. So they tend to dig their heels in, dive in, be aggressive about their stances. And people defend this stuff viscerally, okay? And look, there's nothing wrong with that. Yet you have to have the ability to have disagreements. And one of the things that I ask everybody, and I think you just should ask this of yourselves, if you do happen to have these conversations publicly with your friends and family, is be willing to listen. If people cite opinion, then you walk away. If people cite data, then you engage and try to have a collegial conversation. Because I've found, look, people can change my mind. They do a lot. It's just you have to do that with data and not with opinion. And I think that's the meaningful difference here. As always, we sincerely appreciate you. As I wrap up the show, let me remind you all that the live show is really meant for people who are the fans of the show, who do follow us currently. But if you do know somebody who would like the content that we put out, please tell them to subscribe to the channels, whether that's our LinkedIn or Instagram, YouTube. We're a big fan of that. We're also bringing video to Apple, Spotify when that rolls out in the spring, so look out for that as well. And if you do want to support us, you can go to thspod.com. That's our merch store, and buy any merch there. But the easiest and frankly the personal best thing for you to do, go to joinfridays.com. You see them. They're our sponsor down here. Enter the code HIRE. You can also see that in the show notes, no matter what platform you're on. We'll get a discount, and you'll get the opportunity to improve the quality of your life, whether that's something like a GLP-1, or in my case, I take NAD+. I'm a big, big fan of the product. I love it a whole lot. So until next time, everybody, I sincerely appreciate you tuning in. And for all of you being here, have a wonderful, wonderful weekend. We'll catch you next time. Okay, bye.